and welcome to another edition of the Beyond Your Money podcast. I'm your host, Mike Dukovich. Today, I've invited Jordan Dunsmore, partner and senior wealth manager here at YTS, to join in a conversation about something that's very prevalent in our business, and that's rollovers. Jordan, thanks for coming aboard.
Mike, thanks for having me. Appreciate it.
Absolutely. So, this is something that we deal with every day in our industry, every day in our business. I get asked about this on the street when we're walking in the neighborhood, and that's really the topic of rollovers. It's something that's just integral into our business, integral in financial planning in general. And so I wanted to kind of have a conversation about that with you and talk to our listeners about what they can expect, what that means, what the rules are, what the obligations are, and kind of see where that goes. So thanks for being a part of it.
Of course, yeah. Thanks for having me.
Of course. So Jordan, why don't you start by telling us when rollovers happen? What are the main reasons why people bring up the word rollovers?
Yeah. So the main reasons they happen with your current employer is you've left, you've been fired, you've retired. It's generally those three reasons, and you're no longer with the company. So the funds are there, and generally 401k is one of the top two largest assets that our client have between their home and, again, their employer plan.
Yeah, so really separation from service. That's the key phrase. When you're no longer with your employer, you have a qualified plan that you've been adding to that theoretically maybe they've been adding to as well on your behalf. When you are no longer there, you have an opportunity to think about a rollover. So when a client comes to us and says, "I've had this event, should I roll over my money?" That kind of starts the conversation. And what are some of the things that you have to think about as an advisor before you say, "Yeah, a rollover might be the right way of going for a client"?
Yep. So there's a number of different factors that we'll bring into play. If they are fully retiring, then generally it could be a really good option. If they're switching just to a new employer, if there was other circumstances involved, we're going to look at a number of different things. Their age, when they can start withdrawals from this. So there's probably 10 or so different areas that we look at if it makes sense for a rollover.
That's great. So I guess the key point is it's not a blanket recommendation to roll over. It's something we have to talk about, discuss, analyze, and then we come up with a recommendation for a client.
Yep. It's definitely not a one size fits all.
Right. So, typically when I'm talking to a client about whether or not a rollover makes sense, there are usually four different things that a client could do. Okay. They could leave the money at the old retirement plan, at the old qualified plan, not necessarily, the great, the best decision there. They could roll over to an IRA. They could potentially roll it into the new retirement plan if they have one, or they could take a cash distribution. More often than not, that cash distribution, that is the last, thing that we consider. Just doesn't make a whole lot of sense. If you take a cash distribution, it's a fully taxable event. And so usually that doesn't really make sense in a financial plan. Why don't you talk a little bit about rolling it into the new employer's plan, if that's an option for them? Is that something that you consider?
And that is an option. So when someone leaves their current place of employment to move to another location, generally one way or the other, we're saying it doesn't make a whole lot of sense to leave it at your previous employer. There's no oversight on it. You're not an employee there. So honestly, they just don't really care. So the two scenarios that we see when you work with a new company is roll it into your existing 401k, where you at least have it with the company you're working with, or you can roll it into an IRA and generally get more professional management oversight.
So one of the other benefits, Jordan, is consolidation, right? So I run into a lot of clients when they have a separation from service event, and they always say, "Hey, I also have an old plan somewhere else that I had forgotten about, or I worked for such and such years ago, and I think I have some money there." So when you have that separation from service event, and you're thinking about rolling things over, that's a potential consolidation opportunity, right?
Yeah, it's surprising actually how much that happens in meetings that we have with prospects and clients, just saying, "Oh, I worked at this company 20 years ago. I think I still have a 401k there." And it's really common. So generally the more you can consolidate, the easier it's going to make your life.
One of the other benefits that we tend to talk about when it comes to rolling your money out of a qualified plan and into a self-directed IRA is you typically have more flexibility with regards to distributions, right? When you're in a 401k, again, restrictive. There could be rules on how often you trade, how you can get money out. and so restrictive doesn't necessarily allow you to manage that a piece of the puzzle in a holistic fashion. But when you roll it into an IRA, now you have a lot more opportunities as far as not only how you manage it, but how often you can trade, potentially distributions, beneficiary designations. You have a lot more opportunity there.
Yeah, a lot more opportunity, Roth conversions. It just makes, yeah, your life a lot easier.
Now, let's talk about a handful of reasons why you might want to potentially keep it in the old 401k program or 403b or the old qualified plan.
Mhm.
What are the one or two reasons why you might want to keep it there?
Yeah, and like we said, it's not a one size fits all decision. And a couple of the areas that we take into consideration, like we said, age, client circumstance. If the client needs a hardship withdrawal or needs a loan, they could take a loan on their 401k where they couldn't do that in an IRA. So that's why we're always asking questions beforehand to make sure it is the right decision and that the client doesn't need to, take a loan or withdraw from it immediately.
Yeah, that's a big one that a lot of people have some misconceptions about. If you have a liquidity need in the near term and the plan that you're leaving allows for in-service distributions or has a pretty lucrative loan provision, it could make sense to leave the money there to take advantage of that. But a lot of the things have to align. The stars have to align, I say, in that you need to have that liquidity need and your plan has to allow for it. So, that's a situation I've seen a handful of time in my career where it makes sense to leave the money there. Another big one that we always run into is costs, right? Traditionally, the costs of managing the portfolio in the 401k are low. It's usually institutional type pricing. There's usually not a large advisory fee on top of it. So traditionally, when you move out of a 401k and into a self-directed IRA, costs do go up.
Mhm.
Can you speak to why that could make sense though for that additional cost?
Yeah. And again, I think it kind of comes back to having all those investment options that are available. The cost is low because you're really not getting much service. You generally have 10 to 15 different mutual funds to choose from. And now you're working with a professional money management group like YTS that incorporates the investments, the planning, the insurance, tax guidance. So a number of different factors that come into play where it will be slightly more expensive. It doesn't mean underperformance. It actually just means more oversight on your overall portfolio.
Yeah, that's a great point. The old mantra is you get what you pay for, kind of deal. And it doesn't necessarily mean that every client needs the comprehensive wealth management field. They don't need the ongoing advice and monitoring and maintenance that we would provide in an IRA. Perhaps they know what they're doing. Perhaps they're savvy enough to manage their 401k and to do it diligently and to make meaningful changes when it's warranted, but also to stay away from panicking. But quite frankly, a lot of people don't have that. They don't have that knowledge or that wherewithal or that discipline to stay invested, to ride the market, to rebalance, right? They don't know what they don't know. And so, yes, you could theoretically stay in a qualified plan at a lower fee. But quite frankly, you can get a lot more value if you are looking to have that more holistic approach
Mhm.
and to have people actually helping you manage your affairs.
Yep.
So it's not just about the costs. That's certainly part of the conversation, but it's not the end all be all.
Yep.
As we are having these conversations with clients, we are actually required as advisors and as fiduciaries to take a lot of these things into consideration. In our industry, it's called Reg BI, Regulation Best Interest. And so when we have a client that approaches us and says, "Hey, I've had a separation from service event. Should I roll over my 401k or 403b?" It's not just, yes, let's do it,
Mhm.
right? We do have to go through a process through the Reg BI requirements. And we basically analyze all these things. We analyze the cost difference, the investment difference, what other services might the client need. And so that holistic approach really goes into the decision-making factor on whether or not we recommend a rollover.
Mhm.
So, Jordan, one thing that is also unique in our industry, one thing we've had a lot of success with too, and again, not necessarily right for everybody, but it is something we look at, and it's part of the Reg BI process when we're making these decisions and helping clients. But it's in-service distributions. Why don't you tell us a little bit about what those are and how you've seen those work?
Yep. So it's something that flies under the radar. But once you turn 59 and a half, so you're still with your employer, you can do what's called an in-service rollover, where your 401k will stay open, but the current balance will move over into an IRA that could be self-directed by you, managed by us. But again, just a way to get more professional management. And we have a large number of our clients, once they do hit 59 and a half, will reach out to us, and we've built trust with them for years, and they'll say, hey, I now want you to manage the IRA that's coming from my 401k. Nothing changes. They're still working. They're still getting the company match, but they have the option once they're 59 and a half to do that in-service rollover.
Yeah, it's a great point. Now, it's not available for everybody. The plan has to have that in their summary plan description. So we always ask for the SPD, or the plan document that would highlight whether or not that's part of the plan. But if it is, we've seen it work very, very well. You're moving money out of the portfolio, which is restrictive, right? Which has, we'll call it the menu investments you get to pick from, and no one's helping you manage it. And now you're taking that portfolio and you're moving it to somewhere that you're getting the advice, you're getting the unlimited investment opportunity, you're getting the holistic planning. So it can make a lot of sense. And oh, by the way, you haven't left the company. There's no separation from service event. You can still add to the 401k, right? You're still saving. It's just you've moved the chunk of your wealth, the bigger chunk of your assets, into something that you just have a lot more flexibility with.
Mm-hmm.
So I think it could make a lot of sense. And again, not something that's a blanket recommendation for everybody, but it's something that we can look at. If it's something that is available to your plan and it makes sense, we go through our analysis. It's something that we've seen a lot of success with.
Yep.
Jordan, let's switch gears and now talk about, let's assume the rollover has occurred. Let's assume that the money has moved from the 401 or 403b to an IRA. We now, as advisors, have effectively just, cash,
Mhm.
right? That usually comes in the form of a check. And this does surprise some clients. Usually what happens there is not a wire. It's not an ACH. Usually in today's day and age, and this surprises people, it comes in the form of a check, a paper check.
Yep.
That check traditionally comes to either you as the client, to your address of record. I would say that's probably, 7 out of 10 times, it goes to them. Handful of times they'll allow us as the advisor to receive the check, which just makes it easier.
Yep.
The client doesn't sign or endorse the check. They don't do anything with it. They literally just forward it to us.
Mm-hmm.
But now we have cash. We have cash in an account. The question that inherently pops up when that happens is, what do I do with that? Do I go all in? Do I invest it right away, right out of the gate? Or do we do something different with it?
Mm-hmm.
What do you typically recommend?
Yep. So generally, it's market timing is very, very difficult. So majority of the time, we're recommending let's get it in the market. And with YTS, you're in generally one of our portfolios. It's always our investments that we have the highest conviction on, that we feel are the most timely. So we don't really have any concerns about investing right away. Although I am a big fan of dollar cost averaging for certain situations. It's tried and true. It sounds super boring, but it definitely works. So, maybe clients that are significantly more conservative or have different withdrawal requirements, then we may consider dollar cost averaging over 3 months, 6 months, or a year. But our portfolios are always full of our best ideas at the time. So we generally want to get it invested in the market.
Yeah. You can't win unless you're in, kind of deal, right? But let's talk about dollar cost averaging for just a moment. So dollar cost averaging is something we kind of just take for granted. I find that a lot of clients don't necessarily know or understand what that means. But what dollar cost averaging is instead of just diving all in all at once and getting every dollar invested all at once, you come up with a plan. You come up with a plan that's either based off of time or different bogeys in the market, right? And so, for example, a dollar cost averaging program could say that I'm going to invest 20% of that money every month for 5 months until you're fully invested. And what dollar cost averaging does is it's a hedge. It's a hedge against unlucky timing, right? What you're doing there is you're basically putting a little bit of the money to work at the front end, anticipating that there might be volatility or a downturn in the market in the short term, right? That way you don't have all of your money in all at the onset. To your point, Jordan, this is a conservative way of doing it. If we are in a period of high market volatility, for instance, or if the market is, going down when you're doing that, it could help you sleep at night, knowing that not all of your money is in all at once. It also gives you dry powder, right? If you're doing a slow dollar cost averaging approach into the market, it gives you cash that you could theoretically deploy at a lower level.
Mhm.
Um, Something we can consider, something we always think about when we're talking about putting money to work, whether it's from a rollover or cash in general. But it's not, again, it's not a one size fits all type of strategy. We think about it, we incorporate that into the plan that we're managing for our clients, and if it makes sense, we can utilize it. Um, with a dollar cost averaging type of approach, what do you like to do with the cash that potentially you're sitting on as you're waiting to invest it?
Yeah. So majority of the time, we're going to find a liquid money market fund that's paying the highest rate possible, generally by the one of the larger banks out there. So we know we have strong backing there, but we want to make sure we're getting the highest rate out there in a safe style money market fund.
So it's not just sitting in cash, it is
Yep.
making something. So at least you're making money while you wait. Again, dollar cost averaging is one of those nuanced programs. There are actually studies that show that over time, time in the market itself will actually average out your returns. And this might be counterintuitive, but there are studies that have been done where you look at one portfolio where you dollar cost average, you slowly drip into a portfolio, and you compare that to that same portfolio that you go all in all at once. Over time, and it's usually 7, 8 years down the line, you can't figure out which one is which,
Hmm.
right? And it goes back to your point that um, we run portfolios in an active and ongoing way. So we're managing portfolios to ride the waves, to ride the dips, to avoid the major dislocations, to take advantage of the opportunities that we see. And so, at times it could make sense just to
Hmm.
get into the market.
Yep. Yeah. Timing is just too hard. And I did a video on this a few months ago called The World's Worst Market Timer. I invested in the top of the market in 1973 and 87 and 2000, 2008, right before COVID. And even if they invested at the very worst times, they still average a little over an 8% return. And that was generally the worst case scenario. So again, like we mentioned, 9 times out of 10, it's most makes the most sense just to get it in the market, get it into our top ideas. But there are one-off scenarios where it does make sense to dollar cost average.
And that's a great point, perhaps to bring it home. Not that any of our clients are the worst market timers in the world, but traditionally, when you look at the average investor, right, the average person who might be a laborer or a doctor or a lawyer or a mechanic, right? They're not money managers. They're not
Mhm.
advisors. They're not looking at this stuff day in and day out like we are. Perhaps they're just not educated. They're not in tune with what's going on in the market or the economy. Those folks, when they're in charge of their own 401k, tend to make bad decisions. They tend to try and trade it. They
Yep.
tend to become irrational when the market's getting choppy. And so again, that just speaks to one of the key benefits when we're thinking about rollovers is you want to have help. You want to have guidance,
Mhm.
when you can get it.
Yep. Yeah, and I think that's what we do best. We take the emotion out of it, and I think that's really one of the main reasons that we do see retail investors underperform year after year is because they're tied to the emotion of their investments. They're connected to who's in office right now or other geopolitical events, and they let that kind of cloud their judgment. And that's where we can kind of cut in and take the emotion out of things and just look at the fundamentals and look at the technicals of the market and find the best opportunities for investments.
Yeah, that's great. So Jordan, while we have you, one of the things that I'm really excited about is to be a part of the podcasting family here. But you've been doing a podcast now at YTS for over a year or so,
Mhm.
off the charts. I love it. I'm a huge fan of it. Why don't you go ahead and give a little plug for your podcast?
Yeah. Thanks, Mike. Yeah, off the charts has been fun. We've been doing it for coming up on 2 years now, and a lot of it is questions that I'm getting in client meetings or things I'm seeing on the news. I'll find a chart that's related to that. Really try to simplify it down to a 2 to 3 minute video that everyone can understand, and try to have more of a optimistic vibe to it as well, where there's so much negativity in the world. But yeah, it's always timely, and yeah, check it out on YouTube.
Yeah, certainly do, and I would highly recommend that. It does give you some insight. It gives you some knowledge and some visual confirmation for something that's going on out in the real world. People have a lot of questions about, so I think it's a great value add, and appreciate you doing it.
Yep.
Maybe one of these days you can invite me onto that one.
Love to have you.
And again, I appreciate you coming in and having this discussion. Is something we deal with on a daily basis, something we hear from clients, both existing clients, prospective clients, just people on the street. And so I appreciate you coming and sharing your insight with us.
Yep. Mike, thanks for having me.
Course. So, again, the Beyond Your Money podcast, the goal with this podcast is to educate, it's to inform, it's to empower our clients to make good decisions so that it's not just your investment. It's not just your 529. It's not just your 401k. This is your whole financial picture. And so we want to make sure that we help our clients do things holistically and so that everything complements what you're doing both with your finances, with your family, and with your career. So again, it's your money, it's your life. Take control.